Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Coinbase.
If you find our talks useful, please consider subscribe, like, and comment underneath. And be sure to check out the StockOracle 14-day trial link in the description.
Yeah, that's a great tool.
It really is. Just a quick affiliate disclosure, though. We may earn a commission if you sign up through that link.
Yeah.
And remember that AI insights and value estimates can be wrong, so always verify them yourself.
Right, exactly. Always do your own research.
Yeah. We focus on long-term wealth building here, not short-term trading. So, to be clear, this is not financial advice. We're not telling you to buy, sell, or hold. Okay, let's unpack this.
Let's do it.
Because today we have a deep dive based on a really comprehensive brief from Forward Living Equity Research. The date on this is August 21st, 2026.
And this is such an important time to be looking at this specific company.
It really is, because, usually when you look at a company whose stock has nearly been cut in half over a single year, the story is, well, it's pretty simple.
Right. The business is just failing.
Exactly. The customers are packing up, they're leaving, and the writing is basically spray painted on the wall. It's binary. Broken or not broken.
It's definitely comforting for the market to categorize things that way.
Yeah.
Line goes down, business is bad.
Yeah.
It saves people the trouble of actually reading the balance sheet.
Which is my favorite thing to do, as you know. I am always looking at valuation and capital protection. But then you look under the hood of a company going through a massive structural pivot, and suddenly that simple binary narrative completely falls apart.
Completely.
Because right now, Coinbase is sitting at $172.35. That is down 43.4% over the past year.
A huge drop.
Massive. And the market largely sees them as a declining, money-losing trading venue. But our mission today is to figure out if this is a value trap, where you buy it thinking it's cheap, but you just lose your capital.
Right.
Or if this is a massive sentiment-lagging opportunity. So for you listening, think of this as a masterclass in how to read between the lines when a business model is shifting.
Yeah, because we aren't just doing a post-mortem on a rough year.
Yeah.
We are trying to interpret a business that is fundamentally changing its DNA.
While the broader market is arguably looking the exact opposite way.
Or at least refusing to believe the transformation is real.
Yeah. So we have to start with the fundamental paradox here, the JAP reality versus the underlying business health. Because reading these numbers, it's giving me whiplash.
I don't blame you at all. When you look at the first half of 2026, the surface level numbers are, well, they're objectively ugly.
Really ugly.
Yeah. Revenue dropped 25.4% year over year, down to $2.633 billion.
And the profitability drop is, it's honestly even more shocking.
Oh, it's brutal.
Right. They went from a $1.495 billion net income in the first half of 2025 to
A massive loss.
exactly a $753.6 million net loss in the first half of 2026. That is a massive swing into the red.
It is.
If I'm a casual investor, focused on capital protection, and I just read that headline on my phone, I'm running for the hills.
And most people did, right? Which explains the stock being down 43%. But that massive loss is based on GAAP.
Generally accepted accounting principles.
Exactly. And GAAP includes a lot of non-cash charges and asset impairments.
So in plain English, GAAP forces them to record losses on the falling value of the crypto assets they hold on their balance sheet, even if they haven't actually sold them.
That is a major piece of it, yes.
Yeah.
If Bitcoin crashes during a quarter, GAAP requires them to mark down the value of their holdings.
Which shows up as a loss on the income statement.
Right. But it's a paper loss. The actual cash coming in the door from transaction fees and services tells a very different story. What's fascinating here is that despite those massive GAAP losses, Coinbase just posted its 14th consecutive quarter of positive adjusted EBITDA.
Wait, 14 quarters?
14 quarters straight.
So even through all the brutal crypto winters, the massive volume slumps, the FTX collapse, they were still generating positive earnings before interest, taxes, depreciation, and amortization.
Yep. It tells us that the core operating engine of this company, of the actual cash-generating machine, remains consistently profitable.
Oh.
They are keeping their fixed costs in check. And they are maintaining incredibly high gross margins, currently sitting at 86.35%.
That margin is absurd. That's like elite software as a service territory.
It really is.
That's like Microsoft or Adobe, not a traditional financial exchange. Plus, the research notes they are sitting on a cash cushion of $8.6 billion.
Which is huge.
It's a fortress of a balance sheet. It provides so much downside protection. But the thing that really stood out to me, the absolute core of this structural shift, is where this money is actually coming from now.
The existing engine versus the emerging engine.
Exactly. Subscription and services revenue now makes up nearly 50% of their net revenue.
And that one data point changes the entire thesis for the company.
I was trying to visualize this for our listeners, and it's like, imagine a massive state-of-the-art gym.
Okay, I'm with you.
For years, they relied almost entirely on selling these really expensive day passes to tourists. And tourists are volatile, right?
Right.
If it rains, they show up. But if it's sunny, the gym is completely empty. The revenue is a total roller coaster, so investors hate valuing it highly.
Sure.
But recently, the gym has been quietly transitioning. Now, half of their income is coming from steady, boring, predictable monthly memberships.
Yeah, that recurring revenue.
Right. But the broader market is still just standing outside the gym, counting the day pass tourists, entirely ignoring the direct debits hitting the bank account every single month.
That is a perfect analogy.
Yeah.
The market is currently pricing them based on the volatility of the tourists.
Yeah.
But having nearly half of your revenue come from subscriptions, things like blockchain rewards, custody fees, and stablecoin interest, that fundamentally changes the risk profile.
It smooths out the earnings volatility.
Exactly. In a low-volume crypto environment, which we've been in recently, that recurring revenue acts as a massive buffer. It raises the floor.
Right.
Businesses with that much recurring high-margin revenue tend to warrant a different, much higher valuation multiple because the cash flows are predictable. But as the research clearly shows, the market hasn't priced that stability in yet.
So the subscription base is this hidden stabilizing force. But we can't ignore the elephant in the room.
The tourists.
The tourists still matter. Half their revenue is still deeply tied to crypto trading volumes, which brings us to the immediate catalyst roadmap. We have to talk about the current Bitcoin breakout.
Yeah, the near-term catalyst.
If the subscriptions are the floor, the trading volume is still the engine.
And right now, that engine is getting premium fuel.
Big time. The brief highlights that Bitcoin recently broke past $72,500. And it wasn't just a slow, organic climb. It was fueled by a massive $500 million short squeeze.
Yeah, basically, traders betting against Bitcoin got trapped and were forced to buy back in, which just drives the price up vertically.
And prediction markets are throwing around some wild numbers, hinting at possible 85% gains over the next 6 months.
Which is a huge potential tailwind.
Right, but as someone focused on downside risk, I have to ask, how did Coinbase even survive the last few freezes to be in a position to catch this new wave?
Well, they played a very long, very strategic game. During the recent downturn, while other platforms were imploding, facing federal charges, or, simply running out of cash.
Yeah, that the bad actors?
Exactly. Coinbase tightened its belt and leaned heavily into compliance. They let the reckless competitors die off, and then they swept up the remaining users who wanted a safe, regulated place to trade.
That makes sense.
Through that attrition, Coinbase consolidated its power, capturing a record 10.3% of the global crypto trading market share.
10% is huge in an industry that is notoriously fragmented across, hundreds of global exchanges.
Easily.
But aren't we just tying the company's fate to a roller coaster again? I mean, if that 85% gain prediction doesn't pan out, or if Bitcoin stalls at 72 grand, isn't this just a waiting game for a crypto craze that might not ever arrive?
The market is holding on to that exact skepticism. The stock actually has a beta of 3.42.
Oh, wow. So for context for the listener, a beta of 1 means a stock moves perfectly in sync with the broader market. A beta of 3.42 means it is hypersensitive. If the market sneezes, Coinbase catches a severe cold.
It amplifies volatility to the extreme.
Wrong.
But here is the mechanism that counters that fear. Operating leverage.
Okay, break that down for us, because that sounds like a growth driver.
It is the ultimate growth driver. We mentioned that 86.35% gross margin earlier.
Yeah.
Because they're fixed costs. The servers, the compliance teams, the corporate overhead, because those are already largely covered by that massive recurring subscription revenue base we just talked about.
Oh, I see where this is going.
Right. Any new incremental revenue from a trading volume recovery is essentially pure profit.
So they don't have to hire twice as many engineers just because trading volume doubles. The infrastructure is already built.
The heavy lifting is done.
Yeah.
Because they now hold 10.3% of the market, when the cycle turns, whether it's this month, next quarter, or next year, They capture significantly more of the upside than they did in previous cycles.
That is fascinating.
A sustained retail rally doesn't just increase their revenue by 20%. It exponentially increases their bottom line profit because it all flows straight through that 86% margin.
Yeah.
That operating leverage is the quickest path to erasing that $753 million gap loss and restoring true profitability.
So the short-term fate is still undeniably tied to Bitcoin volumes, but the net they've built to catch that volume is bigger, stronger, and much more efficient than ever.
Exactly.
Let's move away from retail trading entirely, though, because the research points to some medium and long-term catalysts that could completely redefine what Coinbase actually is as a company.
The optionality.
Yeah, the infrastructure pivot. And honestly, this is where the story gets wild.
This is the shift from being a crypto exchange where retail traders buy and sell tokens to becoming multi-trillion-dollar institutional financial infrastructure.
Right.
But to get there, it has to start with the regulatory landscape.
Yes. And for you listening, we need to look at this next point purely objectively as a market catalyst, entirely regardless of politics. We don't take sides here, we're just reporting the research.
Right, just looking at the facts.
So the research notes that President Trump recently urged Congress to pass the Clarity Act, aiming to position the U.S. as, quote, winning the global crypto race.
Yeah.
Now, stripping away the political rhetoric as a structural development, what does this actually mean for a company like Coinbase? Why is a federal market structure bill so important?
It provides the one thing institutions need before they deploy capital. Certainty.
Certainty, yeah.
For years, the biggest discount on Coinbase's valuation has been regulatory overhang, the constant threat of SEC litigation, the uncertainty of what financial products they're legally allowed to offer, and whether certain tokens are securities or commodities.
That's a massive risk factor.
Right. A federal market structure piece of legislation, like the Clarity Act, would effectively remove that dark cloud. Additionally, there are potential SEC rulemakings on the horizon for crypto contracts, which could finally and clearly define product offerings.
So to translate that for the listener, regulatory clarity isn't just about Coinbase avoiding expensive lawsuits or keeping government regulators out of their lobby.
No, not at all.
It is the specific, necessary key that unlocks institutional money. There are trillions of dollars in traditional finance sitting on the sidelines because pension funds, endowments, and major asset managers, well, they cannot, by their own strict legal mandates, invest in unregulated gray area infrastructure.
They need clear rules.
They absolutely do.
If we connect this to the bigger picture, once those rules are in place, you see why their recent global expansion moves are so critical right now. The research highlights that Coinbase just received regulatory approval in Abu Dhabi to build a tokenization hub for fully backed traditional securities.
Fully backed traditional securities. Okay, so we aren't talking about meme coins or dog-themed tokens here.
Not at all.
We're talking about putting traditional finance stocks, bonds, real estate on the blockchain. But why? Explain the mechanism here. Why does a massive bank in Abu Dhabi care if a bond is on a blockchain versus a traditional database?
It comes down to speed, cost, and counterparty risk. The traditional financial system is built on antiquated plumbing.
It really is.
When you buy a stock or a bond today, it typically takes 2 full business days to actually settle, what they call 2+2 settlement.
Right.
During those 2 days, a dozen middlemen are passing ledgers back and forth, and massive banks have to hold billions of dollars in reserve just in case one of those trades fails before it clears.
It's like buying a house and having to wait for the title company, the escrow agent, and the banks to all physically mail paperwork to each other.
Exactly. Tokenization turns that T+2 settlement into T+0. Instant, 24/7 settlement.
Wow.
It eliminates the middlemen. It reduces counterparty risk to almost zero, which frees up billions in capital requirements for massive institutions.
That's a huge value proposition.
It is. Abu Dhabi has created a progressive regulatory sandbox to test this out. Coinbase is building the institutional on-chain settlement plumbing for the future of traditional finance in a regulated jurisdiction.
Right.
If they establish themselves as the trusted, regulated infrastructure for tokenizing traditional assets, their addressable market expands from the crypto-native world to the entire global financial system. It reframes the whole company.
It's like moving from sending physical gold and armored trucks to sending a digital wire transfer, but applied to every financial instrument on Earth.
Exactly.
That is the ultimate long-term wealth-building thesis. But let's play devil's advocate here, because I'm always looking for what could go wrong.
Always a good idea.
If the gym memberships are growing and stabilizing the floor, and if the trading net is bigger than ever to catch the Bitcoin rally, and if the regulatory clouds are parting, why is the stock still struggling?
It's a fair question.
Why is it still down 43%? Let's dive into the bear case and get a technical reality check.
The risks here are very real, and they are currently acting as a heavy anchor on the stock price. The market isn't just ignoring the good news. It is actively weighing the immediate risks. Let's start with what the insiders are doing.
Here's where it gets really interesting and honestly a bit baffling from a valuation perspective. The research flags a major red flag regarding insider activity. We're looking at 46 recent open market sales by insiders, totaling around 59,000 shares.
Yeah.
And how many open market purchases by those same insiders? Exactly 0.
Not a single share bought by an insider on the open market in recent filings.
Wait, if this trillion-dollar infrastructure pivot is real and the stock is trading at a massive 43% discount from its highs, why aren't the people inside the building buying their own stock? Why are the executives cashing out instead of doubling down?
It acts as a massive psychological wet blanket for investors. Now, to provide some context, 59,000 shares isn't a massive, ship-is-sinking liquidation for a company with a market cap this large.
Okay, that's fair.
A lot of this is likely scheduled selling for tax purposes or executive compensation. But the lack of any buying signals a lack of immediate conviction from the people who know the company best.
Right, it doesn't inspire confidence.
When the C-suite isn't buying the dip, it makes retail and institutional investors second-guess the turnaround story. And when you pair that sentiment with the technicals on the chart, you see a market that is deeply conflicted.
So if the people running the place are sitting on their hands, how is the broader market actually trading the stock today? Are we seeing that same hesitation on the charts? The stock recently rallied 16% over 5 days, currently sitting at $172.44.
Yes.
It successfully broke above its 20-day and 50-day moving averages, which, shows some decent short-term momentum.
That recent momentum is likely being dragged upward by that recent Bitcoin surge we discussed. Breaking the 20 and 50-day averages shows some buyers are stepping in. But it is still firmly capped by the 200-day moving average, which is sitting overhead at $199.25. That 200-day average is a major long-term historical resistance level.
For those who don't stare at stock charts all day, think of that 200-day average like a heavy glass ceiling.
Right.
The stock keeps jumping up on good crypto news, but it keeps bumping its head on that $199 mark and falling back down. It just can't break through that long-term psychological anchor.
Furthermore, the Relative Strength Index, or RSI, is sitting at 69.73.
Which means what, exactly? I've always thought of RSI as basically a speedometer for a stock's momentum. If 70 is the top of the gauge, does that mean the engine is redlining?
That's a great way to visualize it. An RSI approaching 70 indicates the recent 16% rally is getting stretched. It's nearing overbought territory, meaning the buyers might be running out of immediate energy. The technical setup shows a stock trying desperately to recover, but running out of breath just as it hits that major historical glass ceiling at 199.
Wow.
And that technical hesitation isn't just random chart noise. It is rooted in the fundamental core risk we discussed at the start, that massive $753 million first-half gap loss.
Right. Despite the amazing subscription buffer, that loss proves they are still fundamentally vulnerable to crypto volume slumps. They are bleeding cash on paper when retail trading dries up.
And this brings us to the most critical near-term hurdle for the entire thesis. The research explicitly states that Q3 2026 earnings are the linchpin.
The base case, essentially.
Yeah, exactly. In Q2, their standalone revenue was $1.2 billion. If Q3 does not show sequential growth from that number, meaning if this current Bitcoin breakout doesn't translate into actual transaction revenue on their platform investor, patience is going to evaporate rapidly.
Because it would mean the volume engine is broken. It would mean that even if Bitcoin hits 80 grand, retail traders aren't actually using Coinbase to buy it anymore, effectively disconnecting the company's revenue from the asset class it relies on.
This raises an important question for anyone looking at this stock. How long can the market price in future potential when the current reality is a gap loss?
Yeah.
The research gives Coinbase an overall assessment of a 6 out of 10, a neutral rating. And when you synthesize the insider selling, the technical resistance, and the need for Q3 execution, that neutral rating makes total
It
sense.
really does.
Until GAAP profitability actually returns, the entire thesis, the subscriptions, the tokenization, the institutional adoption, it is all strictly theoretical.
It's a promise on a whiteboard, not a reality on a balance sheet.
The 43% decline shows the market has efficiently priced in the GAAP losses.
Yeah.
But the market refuses to price in the infrastructure pivot until the company proves it can make money right now, today.
So bringing this all together for you listening and giving our wealth-building verdict here, we are looking at two very distinct paths forward over the next 3 to 5 years. The base case is entirely dependent on the immediate short-term future.
Q3 earnings.
Right. Q3 2026 earnings have to prove that the recent crypto volume is actually returning to their platform and converting it to hard revenue. If it doesn't, the subscription and diversification thesis alone isn't strong enough to carry the current valuation. The stock remains a hostage to retail crypto winters. That's the biggest threat.
But then there is the optimistic blue sky scenario.
Which is where the huge compounding potential lies.
Yes. And we have to emphasize, as the research does, that this is a possibility, not a guarantee or prediction. But in that scenario, the Clarity Act passes, completely removing the regulatory discount.
Huge.
Subscription revenue continues to grow until it forms the vast majority of their income. The Bitcoin rally sustains, providing immense operating leverage that flows straight to the bottom line.
And most importantly, the company re-rates. The market stops valuing them as a volatile, volume-sensitive crypto exchange and starts valuing them as a highly profitable, diversified financial platform.
It's the difference between being valued as a speculative casino and being valued as the critical electrical grid that powers the entire city.
And that is why this deep dive matters so much. Whether you hold the stock, trade crypto, or just find business strategy fascinating, watching Coinbase right now is a real-time lesson in how a company transitions its core economic engine while the market is stubbornly looking the other way.
It is incredibly rare to see a shift this foundational happen in plain sight, with half the investors refusing to believe it.
The transition from a retail trading venue to global institutional infrastructure is currently underway, but the ultimate success of that pivot depends entirely on their ability to survive the current financial volatility while those new seeds grow. Which leaves us with one final provocative thought to ponder. We talked about that Abu Dhabi hub, the push to tokenize fully backed traditional securities, and the move toward instant zero counterparty settlement.
The plumbing of the future.
Yeah. If Coinbase actually succeeds in building that plumbing, if they become the regulated, trusted bridge for traditional finance to settle global assets on-chain, in 5 years, will we even call them a crypto company anymore? Or will they just be the new, upgraded architecture of the traditional stock market?
That's a huge question.
Something to think about until next time. And again, if you found this deep dive useful, please subscribe, like, and comment underneath. And don't forget to check out the StockOracle 14-day trial link in the description. Just remember our affiliate disclosure: we may earn a commission, and always do your own research, as AI insights can be wrong. We'll see you next time on Smart Wealth.